Hello again and welcome back. Thank you for tuning in once again this week. I'm going to get into some statistics I missed from last week for a few of the outlying areas. And of course, I'm going to get into what's happening to the market. I believe the spring market is over. So I'm going to check out some data and some info on that. First of all, let's start off with what I missed last week. You guys like to give me crap in the comments for missing these areas. New Brunswick is not in here because they still didn't report, but here are a few of the areas here. Month over month changes from March to April this year for the average MLS price. Peterborough up 0.5% month over month. Newfoundland and Labrador up 1.7% month over month. Nova Scotia up 5.4%, and Saskatchewan up 6.2% month over month. Moving on to the percent change from the peak on the average MLS price. Peterborough is down 18.3%. Newfoundland and Labrador down 1.9% from their all-time high. Nova Scotia reached a new all-time high in April, just over 0.5% up from their all-time high, and Saskatchewan up 2.2% from their all-time high. Translating that into dollar amounts, Peterborough down $145,000, Newfoundland and Labrador down $6,000 from their peak, Nova Scotia up $3,000, and Saskatchewan new record high of $7,000 over their previous peak. And lastly, checking out the market balance, the sales to new listings ratio. All three areas, Newfoundland, Peterborough, and Nova Scotia, are in balanced territory when it comes to the sales to new listings ratio, and Saskatchewan is in a seller's market. Now, we've had a few places that have reached new all-time highs this year, so I want to kind of map them out to take a look at them and, see where they are. So here they are on the map, all the places with the green stars. So, of course, Alberta, Saskatchewan, Quebec, or Montreal specifically. Quebec tied their all-time high from 2022, but Montreal did beat theirs. Then you have New Brunswick, Nova Scotia, and Newfoundland and Labrador. So I thought that was an interesting map to look at, to kind of map it out, to keep track of the places that are or have reached all-time highs in 2024. And before I go any further, I have had requests from viewers to talk to other agents in other areas like I have been doing recently. Amy was on a video last week from Edmonton area, and I have been on other agent podcasts and YouTube channels in the past, and I post them to my channel also. So if you know of somebody that would like to come on and talk about the specific situation in their area, let me know, and I'd love to have a chat with them. I've had requests for Montreal specifically. So if you know a decent agent out there that would like to chat, let me know. Drop it in the comments or email me or get them to email me. Now moving on to the bigger picture here. What's going on? We're at that point where interest rates have been high for a while and their tolls are really starting to take effect. But I wanted to kind of look at some charts to kind of put this in perspective again. So let's check out this first chart here. This is the Bank of Canada overnight rate. And I've outlined the rate hike cycles. So any of the major rate hike cycles, here you have 1978 to 1981. And I have done this before on the channel, but I wanted to redo it again. 1988 to 1990, 1997 to 2001, 2005 to 2007. That was a great financial crisis. And of course, now 2022 to who knows when. Now, one thing that you have to remember is all of these rate hike cycles were followed by recessions. So I'm going to add those in now. And of course, recessions followed all of these cycles except for the dot-com bubble, but it was a financial crisis, especially in the States. But we did have a small downturn here in Canada from that. So I did include that. So, of course, the recessions overlapped or came right after these rate hike cycles. And these recessions always coincided with when they dropped the rates or started to drop the interest rates. And you can see there, looking at 1981 to 1982, just before they started to drop rates, the recession started. Same with 1990 to 1992. All of them except for 2005 to 2007, but it did happen just right after or almost at the same time that they started to drop interest rates. And of course, here we are now. We haven't started to drop interest rates and we are not in recession yet, but it's coming. Now, looking at the time frames or the amount of time that these rate hike cycles lasted, and I posted this before, but I have updated it. Last time we were 22 months in our current cycle, but looking back at those same cycles we just looked at on the last chart, 41 months. This is from the first hike to the first cut. So, of course, our first hike was in March 2022. But back in 1978 to 1981, it was 41 months from the time they first hiked to the first cut. 1988 to 1990, 28 months. 42 months in 97 to 2001, 27 months in '05 to '07, and we are now sitting at 27 months. We are now in the range where cuts can happen at any time, not necessarily right now immediately. Of course, our next announcement is in June, which it doesn't look like we're going to cut, so we'll be 28 months in then, but we're in the range where things are going to start happening. And again, this is not a prediction. This is based on historical data of these cycles, so it's a very educated guess I'm giving here. Again, looking at the bigger picture, I wanted to look at the yearly data on the boards I have access to. So I have access to the ITSO board and I have access to the Toronto Real Estate Board. Now, the ITSO board, it could contain Toronto listings. So what I've done is I've isolated just the boards or just the areas surrounding the GTA, and I've removed those GTA areas. I'm going to do those separately. So this is the ITSO board, but it doesn't include any GTA data because we can put GTA properties on our listings or on our board. So looking at the chart there, you can see we're actually a little bit lower. The numbers there on the right-hand side. Our average price for all of 2024 right now, and this is right up until yesterday, May the 13th. We are lower now than we were in 2023 for the entirety, but our spring market has ended. It's very clear. I called for this earlier, but it has ended now. The prices are not going up anymore. Listings are sitting and showings are few and far between, especially in my area. And if you look, again, looking at these numbers, you see we're almost at 2021 levels, and we haven't even had our mid-year price declines yet, which happen every year. Now, looking at the average days to sell, it takes longer than the previous 5 years. So far in 2024, it takes longer than any of those years to sell a house. Again, we just had our spring market, so it's not like I'm just including January's data. I'm including right up until May 13th. So the average days on market or days to sell is 38 days in these areas surrounding the GTA. In 2019, it was only 37 days. Again, if you're hearing that the market's going to rip and prices are going to go up this year and you better buy now, well, looking at this data, it doesn't support that theory. This is one statistic that the Toronto Real Estate Board it doesn't track, but we do track it. This is cumulative days on market. So this is if you cancel your listing and relist it, it adds that in. Average days on market doesn't do that. It just does it for your active listing. And if you canceled it, it's not included. Now, when you look at this number, then it's just off the charts. It's 68 days if you add in those canceled listings or those failed attempts at multiple offers when they hold off for a week and that doesn't work and they have to relist it at a higher price. 68 days in 2024. And it was 44 days in 2019. So significantly higher, 50% more time on market than 2019 pre-pandemic and ultra low interest rates, although they were very low back then, but they weren't as ultra low as they were in 2020 or the second half of 2020. Moving on to GTA. So this is from the Toronto Real Estate Board, but is just the GTA. As you can see there, Durham, Halton, Peel, Toronto, and York regions are included. And again, the average price so far in 2024 up until May 13th, which was yesterday, $1,120,000, less than it was in 2023, and quickly heading towards 2021 levels. Moving on to their days on market, they don't have the cumulative days on market like we do in the other area or on the other boards, but you can see 2024 has the highest days on market from any year prior, from the 5 years prior. 2019, 2020, doesn't matter. It's higher in 2024, and we just went through a pretty active spring market, you could say. 3 months ago, if you had to ask anybody, they would have said prices were going up, multiple offers, buy now and get into the market. Well, we're not really hearing that story anymore. It's now the opposite, where I talk to agents. I talked to one yesterday, and he said he just listed a new condo, and nobody's looking at it. And it's like it's a decent place, and it's priced right. Hasn't even had a call in a week or so. Lastly, I want to move on to the Bank of Canada's. They did their release of the Financial Stability Report last week. So I just want to go over some quick key points. I'm not going to go into this too much, But again, their sentiment on the market, and again, it's not good. We're reading between the lines here, but let's just see what they have to say. So this is the release of the Financial Stability Report. It's from Tiff Macklem and Carolyn Rogers, released last week on May 9th. And they did a whole press conference on this and answered many questions. And there was some claim that mortgage payments are going to go up by 60% because of all the renewals. But I just want to take a few things from this just that I thought really caught my attention. First of all, they changed the name of the report, which kind of sets a big red flag to me. When you start changing names, why are you changing names? To make the purpose of this report clear, we've changed its name from the Financial System Review to the Financial Stability Report. So it's kind of alarming that. So it's a financial system, now it's stability. So anyway, I don't know why they would change that. It's kind of alarming to me, but let's keep reading here. There's two messages in here. The first message is that Canada's financial system remains resilient. Okay, that's good. The financial system's resilient, really nothing to worry about by the sounds of it. The second message is that this adjustment still has some way to go and continues to present risks to financial stability. So we went from resilient to risks. So again, mixed messaging here. And again, I've heard this from other sources too. There is mixed messaging in this report. But the report goes on to talk about, the main concerns are both in households and business, leverage of debt, high debt loads, mortgage renewals, and that kind of thing. A lot of focus on households, actually, which is very concerning, but again, not surprising. And at the end of the statement, Carolyn Rogers has this to say: "Let me close by repeating an important point the governor made at the beginning. The connections in the financial system mean that if risks materialize in one sector, they can spread quickly. This puts a premium on preparedness." So resiliency to risks and now preparedness. So they want you to prepare, and they want government to prepare and the institutions to prepare because they know what happens in these cycles. We go through rate hiking cycles and recessions come next. These guys know what's going to come, right? They know there's going to be an economic slowdown, and they want to minimize the risks to the overall economy, but they're worried about specific sectors in the economy that could pose risks to all. I think they're talking about the housing sector myself. They're not specific in what sector they're talking about, but I'm pretty sure it's the housing sector and how Canada relies so much on that. Anyway, let me know what you think in the comments, and until next week, I'll see you then.